What is up, everybody? Welcome back to another episode of Bitcoin and Markets. My name is Ansel Lindner. A little bit of a late night stream here, but had some time, so I wanted to react to this video. I was asked to react to it by my Telegram channel. It is Marty Bent interviewing Matthew Mezinski, and they're talking about base money, the growth of base money, what's going on over the last couple of years. He did release his latest report on Nostr only so far as I know, and then did this video interview. So we're going to go through it. Again, they're talking about base money, and that is bread and butter for me, talking about inflation versus deflation. So we're going to get right into it. Let's share the screen. And before I do that, let me just say up front, I like Marty's stuff. He and I are hardcore Bitcoiners, but we're pretty polar opposites on many things. I've been interviewed by Marty Bent before, and I have interviewed Matt before for FedWatch years ago. So no, both of these guys, don't have anything against them. I just think that they have a little bit of their understanding of exactly what base money is a little bit off, and you'll get that as we go through here. I'm open to being wrong, but this is the conventional. They're using the conventional wisdom, which I think is wrong. So anyway, let's make sure I have my levels going, and they should be okay. I'm not sure where to check that actually on the back end here of the new Restream. And let me see what I have for speed. I'm going to do a little bit fast because they are slow talkers. Let's do it.
Years. So take 72 divided by the 10 minus the percent sign. You will get 7.2 years. So that's kind of the brass tacks of always have. Try to look at it. Don't bother with CPI indices or PP.
I just fast forwarded through the first part, and we're getting into when he's starting to bring up his charts here.
Yeah, indices. I think there's a lot of noise there. Just look at how much money is actually be printing. What's the size of it, and what's the relationship of Bitcoin to that? So we're basically, we were in the last quarter as far as size. We were the big one last quarter is we passed. You may call it. We passed the Bank of England, the balance sheet of the Bank of England. So we passed the oldest fiat currency in the world, the sterling. So Bitcoin at about 1.2 trillion is still larger than sterling, which is about 1.1 trillion dollars equivalent, and marching on. So
he's throwing out all these numbers about. Let me make sure. I had a singy feeling I was muted on Telegram. Stand by. No, I am good to go. All right. So he's throwing out all these numbers for monetary base, and 1.1 trillion for Bitcoin, just surpassing the UK. The next big boys, we got Germany, the US, gold, that type of stuff. We're getting into that top echelon of contenders. But exactly how is he measuring monetary base? That is my question. And let's see. He doesn't say it for a long time in his video, so I'm going to break it in at a later time and go to his website and just show you guys the exact definition that he's using.
Oh, I can show you that if you want to see the actual chart. Here we go. Thank you, Logan. So this is just the this is the curve. You've seen it a lot if you've been following my stuff, right? We topped out at about 30 trillion, a little over 30 trillion at the end of 2021, started 2022. And then we've fallen all the way down to 26 trillion in 2024. But it's an interesting phenomenon here, and I'm trying to quantify it differently. It's kind of like a Wittgenstein's ruler thing. But, we've fallen 4 trillion. But if I asked you, and I mentioned this before, so, I like to give these little quizzes, right? If I asked you, does that mean that banks are on balance printing something like, 10% less money, right, a year, or 5% even? Would you say true or false? Right?
Okay, that wouldn't be 10% less printing. That would be actually contracting. So if this is base money, that would mean that $4 trillion worth of base money disappeared. Not that it was just disinflation. It was actual deflation. And this is one of the problems that a lot of inflationistas have, is they can't explain like when things go against their theory. Everything in their theory has to go in one direction. So then they have to come up with a reason why something isn't the way it is and make things more complicated.
Because we're down over 10%, right? From 30 trillion in 2 years. So does that mean that, 6-7% per year, banks are printing less or something else? I'm leading you into that question.
Yeah, it feels like a trick question. I'm going to say it would seem that they are, but I feel like there's a gotcha to this.
Gotcha is very interesting. They're still they're flat, and I'll show you in a second. But really, what you're seeing here, this decrease down from 30 trillion is other. This is Wittgenstein's ruler, right? We can't orient ourselves because there's 50 different currencies in this data set. What this really is, this 26 trillion less now versus 30 trillion in 2022. What's really happening is all other currencies are losing value against the dollar, but they're flat, or in some cases even printing more units. Follow that?
Okay, so what he's saying here is that there might be more actual units of monetary base, but what they do is he's converting it into dollars. And so since they are going down against the dollar, or the dollar's going up, see, they wouldn't even consider that the dollar is actually strengthening versus these other currencies, then that is what's moving that total down. Just to back up a little bit of how it's not clear, because if you look at commodities prices, the commodities prices are, they've been flat for 15, 20 years in many cases. And so they're just copper is the only major commodity that made a new, very marginal all-time high during this post-COVID period, and this very high CPI period. So some of those things we can tell, we can measure against commodities to see if they're actually, is the dollar weakening, or are these other currencies weakening, or is the dollar going up relative to these other things. It's very hard without a yardstick, like gold in the past or Bitcoin in the future. But it's not clear from what he's saying here that everybody is just still inflating.
So they're still printing. Yes. Yeah. So that's an interesting thing. Now some of them are decreasing. The Fed is decreasing its balance sheet. It got almost to 9 trillion. Now it's at 7 and change. So the big ones, they are down. But overall, it's not necessarily like major decreases. So I'll show you that now here. And my greens may be wrong for this chart actually, but
okay, before he gets into that, I want to take you over to his website, and this is his definition of base money. It's physical currency and bank reserves. And this isn't bank reserves in a bank. This is actually, he's saying master account, the commercial bank's holdings at the central bank. So this is reserves held at the Fed and physical currency. What do you guys notice about these two things in considering my analysis in the past of these two things? They are not fungible. Physical currency and bank reserves are not fungible. I can buy a sandwich with physical currency, but I cannot buy a sandwich with bank reserves. I really can't use bank reserves held at the central bank for anything except for interbank settlement. But sometimes that breaks down, right? That's one reason why the repo market, when it crashed and went bidless, these reserves were not fungible. They went to zero, basically, the price, because the system froze. So his definition of base money is not even fungible with itself. Also, if you go back to his chart, which let me find that other screen now. If you go back to his chart, and you measure bank reserves, okay, versus inflation, there is an inverse correlation. So I've showed you this chart different times of when QE is happening, rates actually rise. And when QE stops, rates fall. So QE, bank reserves held at the Fed, those things do not behave the way that the inflationistas want you to believe that they behave. Also, if I go, I think I still have this pulled up. This is the different one. Let's see if I can find it. Did I have it pulled up? Maybe this is it. Yeah. Okay, so here is an image of bank reserves, and damn, let me try to switch this up. Okay, still can't see it. What the fuck? If I make it there, now you can see it. Okay, so bank reserves, yes, they're going up since the great financial crisis. This is monetary base reserve balances held at the Federal Reserve. But look, previous to this, it was basically at zero. So how can base money be zero? So what he's saying is base money before the great financial crisis must have been purely physical currency, the other half of his monetary base. This is Jeff Schneider's, one of his insights is that reserves can't mean anything because they didn't mean anything before the great financial crisis. It's just something since then that has made these bank reserves go higher. Of course, QE is involved in that and all, but this is not a good definition of monetary base when you do this. If you be zoomed in here, you can see we fluctuated a lot, but it was very tiny. So at a height in 1988, we had 40 billion. And then by 2000, we got all the way down to 12 billion in reserves held at the Fed. But I don't think anybody would tell you the monetary base shrank by that much. Okay, so his definition of monetary base, right off the bat, I would have to take question with. What else do I have marked here? I have down here talking about CPI, but we will get into that in just a second.
So this is like a rolling 12-month thing. So again, you would think that we'd at least be at a rolling negative 10% here per year, being at 30 trillion in 2022 to being at 26 trillion now. But you see, and I'll zoom in, you see the negative numbers, right? These are rolling trailing 12 months, these bars. They're just barely negative. Negative 2% here in the end of 2022, and then we went positive start of 2023, and now we were negative 1.4%.
What that makes me think of is seasonality. Going through the year, some parts of the year, you're going to have, at the first part of the year, you can have more bank lending. So I bet if you looked here, let's see, November through December, January, February. Yeah. So, well, that was more negative. Then it kind of went positive in March, April. That doesn't quite fit, but you can see the trailing 12 months. I would do 6 months. You would get much more negative numbers at that point. The trailing 12 month kind of hides things a little bit in this respect. I would do 6 month, 1 year, and maybe 5 year. And you could see it's going to tell you a lot of different information. 12 month is interesting, but when you get results like this, where it's not really telling you much, you should change it, because this you have to then go in and just draw conclusions based on very little significant data. You should tweak your numbers until you find some significant data, then make a hypothesis, then go out and do more testing or find more data to support that hypothesis. So really, I would change this 12-month moving average. Okay.
In May 2024, now we're negative 0.3% in 2024. So that's very interesting. So just to be clear, what these numbers I'm recording are, this is like, there are a couple different ways to do this, but as I'm doing it, as I've done it for 6 years, is you're taking each monthly growth of each currency. So you have dollars going up, monetary base of euro, yen, all the different central banks are printing or not printing. They could be removing some money, right? And then you weight that by the size of the those monetary bases themselves, of course. But how do we weight that? We have to put in exchange rates there. We have to look at the dollar value of those. But I'm only looking at month by month. So 1 month, if it goes up, blended 2%, it's that, then it's completely. Got my Apple fireworks going there, I think.
We can't see it on the screen now, but
on my hand gestures. Okay. Anyway, point is, it's a month by month thing, and it just resets every month, right? And then I count it over the prior 12 months to give you this number. So it's very interesting that basically you would think from 30 trillion in 2022 down to 26 trillion now, you would see some very big negative numbers when they're not printing as much. And it's true, they have cut back, but overall it's way less than it might seem if you just look at the dollar figure. So again, zooming in, when peak COVID was happening year on year, right? October, November, December 2020, in February 2021, March, we went up blended 33%, all currencies. Okay. And that translated into 29 trillion divided by 20 trillion. Okay. And that actually looks pretty close to the.
When did CPI peak? When did CPI peak? Actually, I'll just look up on my chart. Stand by. Go to here. U.S. inflation rate year over year, and share this. So we have a peak of CPI in June of 2022, and he's showing a peak in that money printing of around, when did he say? Around March of 2021. So very interesting. The deflationary, that deflationary impulse or disinflationary impulse in his chart is starting way over here before we even took off in CPI. So in other words, CPI doesn't really mean anything in this regard to them because it's way late, 18 months late. But okay, let's go back to them. And I want to show one more thing about this. If we go to this version before he zooms in, see this peak here? First off, I want to say that from the Great Financial Crisis, which is up here, and we had stimulus, we had bank bailouts, we had all sorts of QE going on, QE. And then, but since then, it's been in a downward trend. Isn't that interesting? It was in a downward trend until 2019 and going into COVID. And then all of a sudden we had a spike and everyone was claiming this is the new normal. Inflation from QE is here again. But the inflation supposedly was a result from this declining amount. And then when this happened, very few people were saying transitory, especially in Bitcoin. I was one of them. I was saying this is transitory the whole time. I agreed with Powell at the time, and look exactly what happened. This spike looks transitory, does it not? It was transitory the whole time. And this spike, if we go now to zoomed in, it lasts from, let's see, about March right here of 2020 until, let's just go to March of 2022. So that's 2 years. And that's about how long it takes for something to get out of a 12-month rolling window, right? So if you have a 12-month rolling window, which I think is a problem in this case right here, if you have a very high reading, it takes about 12 months to work its way all the way into that number, and then 12 months to work its way out if you have a period of elevated quote unquote inflation. So transitory is always going to look about 2 years, and you could stretch it out to 3 or 4, whatever, but it's always going to be about 2 years because that's just built into the year over year way that we measure it. But yeah, I just wanted to point that out, that you can see the transitory right here on this chart.
No, but
from my hand gestures. Okay. Anyway, point is, it's a month by month thing. And it just resets every month, right? And then I count it over the prior 12 months to give you this number. So it's very interesting that basically you would think from 30 trillion in 2022 down to 26 trillion now, you would see some very.
I'm gonna fast forward to another timestamp I have, about 1450.
Like they did not shed 10% per year of their, or 10% over 2 years, a little bit more than that, right? Of their balance sheets. They're more or less flat, a little bit down. So that's pretty interesting, in my opinion. Shows you that, getting closer to the end game or something because those currencies just are losing value massively against the dollar. And it's just getting wild. I mean, just look at this chart. So anyway, if you want to take all the noise away, the number that doesn't really change, that's been this way almost since I've been starting this, right? Sometimes it's been closer to 13%, sometimes it's been closer to 12%. But this black line, that's if you take a weighted average of the entire series.
Okay, so he added this black line as a CGAR for this entire period. What I don't like about this is that the global monetary system had a qualitative shift during the great financial crisis. We were able to continue to expand in credit. Not necessarily base money, but base money would expand as well as a effect of the esoteric shadow banking system expanding and funding global growth and global economy. That had a qualitative break during the great financial crisis, and you see it by this downward sloping. So I would like to see an average for earlier period, maybe going up until LTCM 1997 roughly, or .com, and then after to great financial crisis, and then down. So each period is going to be different. It's going to have different characteristics. We don't have the same money that we did back in 1971. Yes, that's when we went off the gold standard, but things have changed so radically. You know, we have all of these different exotic derivatives. We have a repo market that's different. We have tri-party repo. We have all sorts of different layers in the shadow banking system, as well as reserves held at the Fed. I showed you that reserves held at the Fed really didn't start until the great financial crisis. And so this era should not be considered in the same light as the era since the great financial crisis. If you do that, you will see it's downward sloping. We have a transitory spike, and now we're back here. Because why? Because the entire system that is predicated on credit creation is starting to malfunction. Okay. In the post today that I wrote for Bitcoin and Markets, I called it outdated and collapsing because it is no longer functioning properly. And you can see the decline here in this downward slope. And then a temporary bounce that had there was no way this was going to lead to runaway inflation. It was always going to be transitory because we are at the end of this credit-based system, because the credit-based system is malfunctioning. It cannot, the diminishing marginal return on credit does not allow for us to inflate our way out of this because we're at the end of the capability of debt burden and of wasteful spending and of malinvestment and all of that stuff. There's been no creative destruction since the great financial crisis. And so we had a qualitative shift at that point, and this was just a blip and back down to normal. So I expect this to continue for the foreseeable future. If they're measuring it in dollars, which I think here is a mistake because the dollar is going to survive. You know, one of the assumptions behind this data is that the dollar will not survive. That the dollar is in the worst position of most currencies. But as we go forward, if this is normalized to dollars, which is what he's saying, this will continue to fall because all other currencies will be devalued against the dollar. The dollar will be the last one standing. It's always been a game versus Bitcoin, dollar versus Bitcoin. And yeah, so that's what I would say to that. But let's see. I had something else down here about balance sheet construction. I don't remember what that note was about. Let me rewind here a few seconds and see if that jogs my memory.
Or 10% over 2 years, a little bit more than that, right? Of their balance sheets. They're more or less flat, a little bit down. That's pretty interesting, in my opinion. Shows you that, you know, we're getting closer to the end game or something because those currencies just are losing value massively against the dollar. And it's just getting wild. I mean, just look at this chart. So anyway, if you want to take all the noise away, the number that doesn't really change, that's been this way almost since I've been.
Okay, my memory is not jogged, but I will say something about balance sheet construction. So Well, they talk about Operation Twist later, so maybe I'll just wait for that. Let's fast forward to 2249. After his ad. There we go.
E20 at checkout, and they'll get 20% off their first BitKey.
Well, that begs the question: how aggressive is the money printing going to be on the back end of this? Because we look at inflation, despite the fact that CPI would have you believe that it is somewhat closer to the 2% target. People do not feel that at the grocery store, at the gas station, when they're buying insurance, in the housing market. It is really windy here, freaks. I'm sorry if it's distracting, but the show must go on. You look at commercial real estate, seems to be rolling over. Their jobs reports, they overreported by 1 million jobs this year. The jobs market is not as strong as they were positioning. Props where props are due. They did revise GDP, Q2 GDP higher to 3%. So it seems like GDP may be higher, but.
Okay, they're going to go on a little bit on GDP, and we'll talk about that. But just to address Marty's points there, CPI is down. PPI is down to 2% roughly. If you annualize month over month, or you take a 3-month or a 6-month average instead of a year over year, then it is at 2%. It was transitory the whole time because of the way the structure of the system is. So most of those points there, I covered those. Oh, and jobs were corrected by close to 1 million jobs. However, it was the establishment report, which was already, we knew, way out of line with the household survey, up to 4 million jobs difference. And people were looking suspiciously at this huge gap between the two surveys that are both done by the BLS, but with two different methodologies. And so it was not a surprise that there was this big job cut, maybe to the Fed, maybe to some people out there. But no, it was not a surprise because of this gap. They still have another 75% of the gap to close between the two surveys. What else? He said something else there, but don't remember it. Let's keep going.
Haven't dove into the intricacies of that print and how that can be manipulated. But it seems like, was this rate hike regime successful in any way in your mind? And whether or not it was successful, like what do you think lays ahead of us with Powell? No,
I'll let him answer, but really it doesn't matter. The rate hikes didn't matter. It's a psychological operation. It's nothing mechanical with the Federal Reserve. They are simply a psychological manipulator of the market. So the rate hikes worked, I guess, from a psychological perspective, but they didn't do anything mechanically. Everything was already baked in the cake because of the way the system functions. If you understand that the system is at the end of a credit bubble and we're popping, it's just going to take a generation to pop, that all this stuff makes sense. It all becomes clear. Okay.
Explicitly saying that they're going to pivot next month.
Right. I think it was par for the course in the context of this new normal that we're in. That new normal being this just crazy peaks and troughs and spikes that I showed you in the last 25 years. It's par for the course of the new normal, and it's going to continue. Obviously, more aggressive than they would like you to believe. But as for the rest, and actually, I could show you GDP because I showed this one on the.
Before he does that, guys, put your comments down below if you have any. If you're watching this later, put your comments down below. Call me out. Call me an idiot. I don't care. Try to get to the bottom. You guys might turn a light bulb on for me, or I might turn a light bulb on for you. So have at it in the comments.
I showed this one on the exhibit as well. So here's GDP over like 200 years of the U.S. It's an exponential growth, and it's exponential because if you put it on log scale, it's a straight line, right? Okay. So there's the Great Depression, fell way below the all-time trend here after October 1929. And then, interestingly, if you look at the growth of the 80s in particular, and then into the internet age, you see that we're up at the top end of this trend. So we actually are above trend. And I don't trade this. I'm not saying that this is like gospel or something. Maybe someone can go back and find some more interesting data. And it looks like I have no idea why.
I'll point out a couple things here before he continues. 1971, If we go up from there, let me try to go up as straight as I can. Right on trend in 1971. What happens after 1971, guys? What happens after 1971? Growth accelerates. And it stays higher for a very long time. Until when? When it stays at this upper percentile band, which is plus 2.5% higher than normal. Until when? The great financial crisis. And I wish I could zoom in on this a little bit more, because that is just pretty amazing that this acceleration really starts right here in 1971. It's above trend for a very long time until 2008. And what happens then? The trend slows back down. It opens up this tiniest gap here between this top percentile and the mean. It slows down. Well, that's not good. That's not good, because in a credit-based system, you need to continue to expand or you have contraction. Now, I'm not saying that a credit-based system is the best. I'm not saying that we need to get back and fix this credit-based system or anything like that. I'm just pointing out the facts here, that in a credit-based system, if you have slowed growth, you will have defaults. Period. I'm not trying to put a value judgment on it one way or the other. I'm telling you what is happening. And what is happening right now is growth is slowing, which is death for a credit-based system. And when did that credit-based system really kick off? Hard? 1971. I mean, it did kick off even earlier, back after World War II, because the Eurodollar system started like in the 50s. And then it really came roaring to life in the 70s after the gold window stopped. But you can see that was a period of rising growth. Growth rates were continuing to go higher. And then in 2008, great financial crisis, something broke and growth has slowed. And that is the death knell for a credit-based system. I'll also point out, I dislike charts like this that go back this far, because it's a completely different economy. Completely different economy. I mean, you don't want to compare yourself to the 18th century where 95% of people lived on farms. Agriculture was, 90% of the economy. Yeah, they had high growth rates back then, but there's probably whatever technology was invented that was making this growth rate really high for agricultural societies. And then I'll note, once they go this period, actually, where was this? About 1871, right? That's where roughly the classical gold standard starts. People aren't going to like this, but I'm using his data. Okay, 1871, which is interesting that it was 100 years before 1971. I just realized that. 1871, classical gold standard in the world. Germany goes on the gold standard, all that. And what happens to growth? Starts missing trend. We go onto a commodity standard. We're on like a silver standard stuff, a bimetallic standard. But we go onto the world goes onto the classical gold standard. And what happens to growth? It goes below trend. It goes below trend, people. What happens when credit-based money happens? It goes above trend. You see the difference? Gold standard, below trend. Credit standard, above trend growth. That's plain as day. And so if we go back to a commodity standard, which I think we will, I'm a Bitcoin bug, a Bitcoiner. I think we're going back to a commodity standard, and that commodity standard will be Bitcoin. But what should we expect from growth? We should expect it to be below trend. Just like this chart tells us.
Why it's like above trend, right? In the early 1800s, I mean, the United States wasn't that great and they had a lot of national debt at that point, but whatever. In any event, the all-time trend is if you measured the slope of this curve, okay, the all-time trend of GDP is, and I'm not showing it here, but it is 5%. So that's the just all-time slope of this black line.
I'll say this, that imagine being our parents, like my parents in the 80s and 90s. when they had this above trend growth. Those are the boomers now, right? The boomers had this, they enjoyed this above trend growth. We're enjoying a slowing growth in a credit bubble. Very big difference.
Line per year, 5% per year. And you see that on a dollar basis, 28 trillion and change ending June, where the trend line is only 17 trillion. So again, this, depending on how much data you take, the trend line's not really important here.
And they're also measuring,
just to show you really.
Oh, I wanted to get that green part. Hold on, where he's showing the green.
And
there we go. So you can see it comes away from this line, right? So the slope of this from the great financial crisis after is below trend growth because it's separating from that line, below trend growth. Because if it was down here on this black line, it would be going separating from the black line as well. So this is below trend growth, even though it is technically above this line, but it is the slope of it is what matters. It's slowing down. Now this little pop here is from COVID spending, because GDP is a flawed metric. It's the king of all macroeconomic metrics. It's the center of macroeconomic thought, and it's flawed because it includes government spending. There's different ways that they can manipulate what's counted for how much, and so it is a flawed metric, but it's the best thing we have right now. I would love to replace it in the future if that's possible, but for right now, the reason for this bump is because of the government spending during COVID. And it didn't even really do much. It just kind of brought us back to regular trend growth, but that's going to roll over again. This green growth is going to go sideways to down over the next 5 to 10 years. Out here to 2030, this will be probably below this black line by that time. So what does that do to a credit bubble? It makes it impossible to maintain.
You see that on a dollar basis, 28 trillion and change ending June, where the trend line is only 17 trillion. So again, this, depending on how much data you take, the trend line's not really important here. It's just to show you really the growth rate. And yeah, I think some of it is manipulated, some of it's inflation, and some of it is the internet. Because you see it that after the last 25 years, basically, it's always kind of at a higher level than what it has been in the past. So this is like GDP is just.
I wonder what Matt would say is the definition of inflation. Would he say it's prices, or would he say it's the monetary base growing?
As you know, and we've talked about a lot, it's just nothing to really get that excited about. It's always going to go up as long as we're in this fiat system. They're going to print to make it go up. It goes up at 5% per year, and as far as I'm concerned, like that is that.
I mean, it's the best fit line, but really another reason why this is bad to do something for this length of time is because from right here of 1871 until 1900, so that's 30 years, 40 years, no, 30 years below 5% growth by a lot during the classical gold standard, by the way. As it's separating from the trend line, it's below trend growth, but this long-term growth line wouldn't pick that out. It would say that's insignificant. Oh, it doesn't matter. It's 5%, but 30 years is a long time. Same with this era from 1921 to roughly 1945. It didn't change all that much in this era. So another 25, 30 years. We're going to go through an era just like that, 25 to 30 years, where the monetary base, quote unquote monetary base, doesn't grow, where GDP doesn't grow. All right. All right.
Yeah.
And the next point I have here is at 50 minutes. We'll just do one more because we are at the 40-minute mark for this live stream. 50 is where I'm going next. You guys can put your comments down below. So let's see what this is all about. This is about Operation Twist.
Part of the conversation to focus on the jokers, what they're doing. I mean, We talked about treasury issuance earlier, but I think what's become more well known since the last time we talked is the auctions that are happening, the duration of the debt that's being issued. It seems like they've been heavily dependent on the front end of the curve, short-term bills over long-term bonds, and so you have the situation where that has had somewhat of an quantitative easing effect on the markets as well. So like stealth QE from the Treasury and not the Fed this time around. If you looked into that, there was a paper written about it a couple months ago, funnily enough, co-written by Nouriel Roubini, but I read it. It was pretty good. But it seems like with the Fed being steadfast and holding up rates higher and for longer, the Treasury decided that they needed to step in and sort of inject some liquidity into markets with these front-end loaded Treasury auctions over the last 2 years.
Yeah, that's he's talking about the Treasury buybacks. I think that's what he's talking about here. And what they're doing is they're buying like 10 and 20 and 30-year bonds and buying them with proceeds that they made off of short bill duration sales. So they'll sell some 6-month debt, some bills, and they'll use that money to then buy back the 10-year. So net, it is a flat transaction. They're not increasing the amount of debt or the amount of treasuries out there in the market. They're simply twisting them from immaturity. And I think the original Operation Twist was the reverse of that. Okay, so they were selling 10-year bonds and using that to buy up bills. So just the exact opposite. Now, what do they hope to accomplish by this, and why did they do this? Well, they learned their lesson from the Great Financial Crisis and from 2019. What happened in 2019? All of the longer duration bonds became illiquid. So if they sold a 10-year bond 3 years ago, that thing went to zero in value during the crisis, during the repo rumble, and even during the Great Financial Crisis. Those markets went bidless. Those are called off-the-run treasuries. On the run are newly issued bills or even newly issued bonds. So the most recent issue of 10-year treasuries are more valuable than 3-year-old issues of 10-year treasuries. And so if you are scared that the market is going to become illiquid, that there's going to be some sort of financial crisis like March of 2023 or September 2019 or September of 2009, you don't want that illiquidity to happen. So you're going to take some of the older stuff and swap it for new stuff that's going to be more liquid. It's going to maintain its liquidity better in the market without changing the debt. That's what this Operation Twist is all about, because they learned lessons from these other periods. All right, let's continue.
Yeah, I haven't read it, but I mean, I understand the concept, and that's clearly they're going to have to keep doing something to keep the interest there, and it's not envious of a Fed official's position at this point. It's just
okay. I wanted to play that little clip of him saying that because it shows his thinking. So they say they have to do something to keep interest. So basically saying that there's going to be a lack of demand for U.S. government debt, but that's never happened, right? That's as we go into recession, the demand increases. We've recently seen the 10-year and the 2-year and all maturities really dive. So let's go to the 10-year, and I'll share this, and we'll go to a weekly. So what does this mean? Just ask yourself what this means. With interest rates going down, it means there is more demand. They don't have to stimulate demand. Matt said that these people are trying to keep interest in the market, demand in the market for these treasuries. Rates are going down substantially from a peak of 5% down now to 3.8%. That's a significant move. And where's it coming from? Look down here. What the heck? How could interest rates get this low if there's no demand? Well, what they'll say is it's QE. But if you go back and you plot all of the times when we've had QE, and I don't know if it's on this chart. Did I do this? QE, are these the QEs? I can't tell. I think these might be the QE windows, but if you go and you plot the QE periods, when QE is happening, rates go higher. Then QE stops, rates go lower. When QE is on, rates go higher. That's the exact opposite of what the inflationistas will tell you. QE is adding a bid, adding demand to the market, which is not the case. Interest rates work actually reverse of what most people think. So we're here, and you're telling me there's less demand right here than there was up here at 10%? Come on now. People want safe and liquid. They have to have safe and liquid because we're in a bust. We're in a global credit bust. And so it's amazing that we could get up to 5%, to be honest with you, on the 10-year. So, all right, let's go back to the video. And what else did he say there? Let me rewind a couple seconds.
Doing something to keep the interest there. And, it's not envious of a Fed official's position at this point. It's just.
Why? The Fed doesn't do anything. The Fed does not do anything mechanically. They're always late. They always follow the market. So going back to that 10-year, and let's actually go to the 2-year, because sorry about that loud sound there. US 2 years even more. And actually we're going to add in here. We're just going to add in here the upper. Okay. And make it regular. Okay. So just take a look at this. 2-year. The 2 years coming down. This is back in 95. We could go back all the way to 81 if we want, because it's the exact same each time. So market rates fall, go below the Fed funds rate, then the Fed funds start to cut, then it popped up, then it led on the way down, right? Then it was above, then it fell below, then they cut. Here, it was above, fell below, then they start cutting in the .com, and they keep cutting, and they keep cutting. Oh, maybe we've done enough. Nope, it continues to fall. We got to keep cutting. It continues to fall. We got to keep cutting. Okay, then it rises up here in Great Financial Crisis. And the 2-year was obeying, and the Fed was following on the way up. Then, what happened here? The Fed went above the 2-year, and the 2-year said, market is in charge. We're down here. Blah, 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 blah. Then it falls hard right here in January of 2007. Hard right here in August of 2000, or sorry, this is July 2007, August of 2007. Then the Fed cuts. After 2 months of big downward monthly candles, then the Fed starts following it all the way down. Market jumps up. Oh, maybe we're good. So they hold rates steady. Nope, bottom falls out again, goes below the Fed funds range, and they keep cutting all the way down to 0. All right. So the Fed just follows every time. Same here. 2-year is going up. If we make this bigger, you can see the 2-year is going up for a long time. Then the Fed follows. Boom. Taper tantrum. A little bit of figuring things out. Can they actually do this? Yep. We're going up here. November, the market moves higher. Then December, the Fed follows. All the way up, guys. The Fed always follows the market. They don't do anything. They're psychological, man. They're tricking you. They're fooling you here. Look at this. Falls down through. Powell keeps it steady. thinking, oh, maybe we can have a soft landing or whatever, keeps falling. Finally, some mid-cycle adjustments here in middle of 2019. I've talked about this a lot. This was the Fed. This was Powell cutting before the bottom fell out. Then it kind of stabilized. So they stabilized. Then the bottom falls out again. Then they finally cut all the way out here in March. But the bottom was falling out for 2 months prior. So the Fed follows. They're not in charge of anything. Same thing here. Look at this. Fed comes up. They start easing off after the 2-year led. See, the 2 years leading. They kind of come up. Then they slow down here as the 2-year passes underneath. Uh-oh, maybe we've done too much. Let's hold it real hard. Hold it here. Then, boom, the bottom starts falling out. Look at the bottom falling out of this. They're going to cut. They're going to cut big. I think they're going more than 25. Based on the 2-year here, I could see them cutting at least 50. At least 50, if not 100 basis points. I mean, they're running out of time. It's only 2 weeks until the FOMC. But if this really turns around and starts falling hard, they're going to cut big because they follow. They're psychologically managing the market, not mechanically. Oh, the Fed's got to do something. Okay, we'll cut 100 basis points. So I would love to be a Fed official. Matt says he's not envious of them, but I would love to be the Fed official right now because all you do is just follow the market. And you have to write a statement, wordsmith your statement so that it comes out to whatever psychological operations you want to pull on the market. But it's an easy job. You just follow what the market's going to do. The market is in charge, not the Fed. And they want to help the stock market. The bond market. They're much more concerned about the bond market than they are about the stock market because the bond market is like 10 times bigger. So they really care about this. This is the reserves of all the banks. It is all their assets and all that. And if there's major problems and there's a rush for liquidity, because a crash down in interest rates is a rush for liquidity. It's not a good thing. What people think is, oh, rates go down, that's stimulatory because people will borrow more. But that's not how it happens. Rates fall because people are scared. Okay, so the Fed has to come in and say, we're doing something, we're here, we got it. 50 basis point cut, 100 basis point cut. That's what's going to happen. All right, so that's all I had for this video. I recommend guys go and watch this all the way through. Marty's a good guy. Matt's a good guy. They put out great content. I just happen to disagree. I think they're wrong about the way the inflationista side of the house is wrong about this. We're going into a deflationary bust, and any sort of money printing is only transitory to try to reflate the bubble, but we can't because there's so much malinvestment that must be unwound globally. And you can see that in all the other currencies having a harder time against the dollar than the dollar is. China's having a hard time. Japan's having a hard time. The UK, the Eurozone, Europe, all of these economies are having a much harder time right now than the US economy. And so the inflationistas just have this completely backwards. All right. So that's going to do it for today. Before I go, let me just check the comments. John Delaney is here. What's up, my guy? Yeah, late night stream. Thought maybe we could get a few new viewers. So if you guys are new, make sure to like, comment, subscribe. Appreciate you guys hanging out. Go back and watch some of my other live streams. The one on Monday. So was that yesterday? Yeah, pretty good. Check that out. That is over the fundamentals report, and like doing those every Monday. But all right, that's it. Let me check Telegram. Sorry. Let me check Telegram. See if there's no other comments there. Okay. All right. So now I can actually go to this one, bitcoinandmarkets.com. Check it out. Subscribe. Put out this oil price free post today on the blog. So check that out. Subscribe over there. Appreciate all you guys that are subscribing and supporting over on bitcoinandmarkets.com. All right. That's it, guys. See you on the next one. Bye.